73% of Americans think that moving into a higher tax bracket means all of their income gets taxed at that higher rate. That's completely wrong, and this misconception is costing people thousands of dollars in bad financial decisions. I've seen people turn down raises because they thought they'd take home less money. I've watched folks refuse overtime because they were terrified of jumping brackets. And it's all based on a fundamental misunderstanding of how the system actually works. Here's the truth. Tax brackets work nothing like most people think. And once you understand how they really function, you'll never stress about them again. In this video, I'm going to show you exactly how tax brackets work using real numbers from 2026. We'll destroy the biggest myths, run through actual examples, and I'll show you why getting a raise is always a good thing for your wallet. Plus, I'll reveal the strategies that wealthy people use to legally reduce their tax burden that you can start using today. Let's dive in. 73% wrong about taxes. Let me tell you about Sarah. She's a marketing manager who got offered a promotion that would bump her salary from $65,000 to $75,000. That's a $10,000 raise. Life-changing money. But Sarah almost turned it down. Why? Because she looked up the tax brackets and saw that $75,000 would push her into the 22% bracket, while she was currently in the 12% bracket. She thought, if I make more money, the government is going to take 22% instead of 12%. That's almost double. I'll actually lose money by taking this promotion. This is the single biggest tax myth in America, and it's based on a complete misunderstanding of the word marginal. Here's what marginal actually means. When you move into a higher tax bracket, only the income above that bracket threshold gets taxed at the higher rate. Not all your income, not even most of it, just the amount over the line. Only income above the threshold gets taxed higher. Think of tax brackets like water flowing into buckets. You have 7 buckets stacked up. Each bucket represents a tax bracket. The first bucket is the 10% bracket. The second is 12%. Then 22, 24, 32, 35, and 37%. Your income is the water. As you earn money, you fill up the first bucket completely before any water spills into the second bucket. Then you fill that one before moving to the third, and so on. For 2026, if you're single, the first bucket holds income from $0 to $11,600. That gets taxed at 10%. The second bucket holds income from $11,600 to $47,150. That portion gets taxed at 12%. The third bucket is $47,150 to $100,525. That gets 22%. Notice something? Each rate only applies to the income in that bucket, not to all the buckets below it. Let me show you exactly what this means with real numbers. Let's say you make exactly $65,000 in 2026 as a single filer. Here's your actual tax bill. First, the standard deduction for 2026 is $14,600. That comes right off the top. So your taxable income is actually $50,400, not $65,000. Now we fill the buckets. The first $11,600 gets taxed at 10%. That's $1,160 in taxes. The next $35,550 gets taxed at 12%. That's $4,266. The remaining $3,250 gets taxed at 22%. That's $715. Add it all up, your total federal income tax is $6,141. Your effective tax rate is 9.4%. Notice that, even though you're technically in the 22% bracket, your effective tax rate is only 9.4%. That's because most of your income was taxed at the lower rates. This is the key difference between your marginal rate and your effective rate. Your marginal rate is the rate on your last dollar earned. Your effective rate is what percentage of your total income you actually pay in taxes. Now let's go back to Sarah and her promotion. Remember, she was worried that jumping from $65,000 to $75,000 would destroy her finances. Let's run the numbers on $75,000. After the $14,600 standard deduction, her taxable income is $60,400. First bucket, $11,600 at 10%. That's $1,160. Second bucket, $35,550 at 12%. $4,266. Third bucket, $13,250 at 22%. That's $2,915. Her total tax? $8,341. Compared to $6,141 at $65,000 income. She's paying $2,200 more in taxes, but she's making $10,000 more in income. That means she's keeping $7,800 more. Not losing money, not breaking even, making almost $8,000 more per year by taking the promotion. Sarah keeps $7,800 more. Here's the iron law of progressive tax brackets. You will never take home less money by earning more money. It's mathematically impossible. Every additional dollar you earn is taxed at your marginal rate, but you still keep the rest. Even if you jump from the 32% bracket to the 37% bracket, only the dollars above that threshold get taxed at 37%. You're still keeping 63 cents of every dollar in that top bracket. Now, are there situations where earning more can affect other benefits? Yes. Some government assistance programs have income cutoffs. Some tax credits phase out at higher incomes. Student loan payments might increase, but these are separate from tax brackets. The tax bracket itself will never cause you to lose money. If you're worried about losing benefits, that's a different calculation. But don't turn down a raise because you think the IRS is going to take it all. They won't. You always keep more when you earn more. Let's talk about what happens at higher income levels. If you're making $200,000, your marginal rate is 32% for 2026. But your effective rate? Only about 23%. Why? Because you still filled all those lower buckets first. You still got the benefit of the 10% rate on your first chunk of income, the 12% rate on the next chunk, and so on. This is why high earners focus so much on deductions and tax advantage accounts. A deduction at the 32% marginal rate saves 32 cents per dollar. That adds up fast when you're moving serious money. Speaking of which, let's talk about the strategies wealthy people use that you can use too, regardless of your income level. First, maxing out retirement accounts. In 2026, you can contribute $23,000 to a 401k. That $23,000 comes off your taxable income. If you're in the 24% bracket, that's saving you $5,520 in federal taxes alone. Plus, it's growing tax-deferred for retirement. Second, health savings accounts. If you have a high-deductible health plan, you can contribute $4,300 as an individual or $8,550 as a family in 2026. Triple tax advantaged. Contributions are deductible. Growth is tax-free. Withdrawals for medical expenses are tax-free. Third, understanding capital gains. Long-term capital gains are taxed at lower rates than ordinary income. 0, 15, or 20% depending on your income. This is why investors talk about tax-efficient investing. The key is knowing that tax brackets are progressive, not a cliff. Every strategy is about legally reducing taxable income, not about avoiding tax brackets. Because now you know, brackets aren't scary. If you found this helpful, smash that like button and subscribe to Operation Wealthy for more practical money skills. Your support helps us create more content like this. So what should you do with this information? First, stop worrying about tax brackets when considering a raise or promotion. More income is always better. Always. Second, calculate your actual effective tax rate. Take your total tax paid, divide by your total income. That's your real rate. It's probably way lower than you think. Third, focus on legitimate tax reduction strategies. Maximize retirement contributions. Use HSAs if you qualify. Take advantage of deductions you're entitled to. These actually work. Fourth, when someone tells you they turned down money because of taxes, educate them. Share this video. You'll literally be helping them make better financial decisions. They'll thank you. Understanding tax brackets is one of the most powerful pieces of financial knowledge you can have. It removes fear. It helps you make smarter decisions. And it puts you ahead of the 73% who still don't get it. Now you're in the 27% who do. Use that advantage.